So as we come into the Roth projection tool, we see a control panel here on the left-hand side. We have the control panel on the left-hand side. We have graphs on the right-hand side. Very, very tempting to go ahead and start rushing right down to the Roth, to the Roth conversions and starting entering those to see what's going to happen. But I would encourage you not to do that and just kind of build a foundation of what this Roth projection is going to look like first. I'm going to skip down to assets here in the control panel. And what I'm going to do is I'm going to be entering in a case study here today. We have a cheat sheet to that case study that's in our articles that we link to in today's webinar. So if you want to replicate this exact scenario, you certainly can. I'm going off of a cheat sheet here, so as I look off to the right, that's where I'm getting information from. So we're going to start with assets here on the left-hand side, and we're going to indicate the assets that they have. So I'm going to, in this case, we have $250,000 of taxable assets and a cost basis of $100,000. Taxable assets are going to include anything that's a non-retirement account. So this is your checking account, savings account, brokerage account, anything non-qualified. We want to make sure it's in this taxable assets pot. The basis is important because once we start making distributions out of that taxable assets balance, that's going to tell us in this case, we have $150,000 of net capital gains that are going to be taxed at a long-term capital gains rate. So it's important to include both the taxable asset balance and the cost basis as well. Tax deferred assets, these are any assets that are subject to RMDs. We're going to say that both Bob and Jane each have $500,000 each, and let's just call it a rollover IRA for each of them. Tax deferred assets, so anything that generates an RMD, Holistiplan is going to use this account balance and their date of birth to generate or project out the RMDs for those accounts. Inherited IRAs or anything that's inherited, these don't go in the tax deferred assets category. It's best to enter those as annuity income, which we'll see a little bit later. We'll cover the income sources a little bit later. So this tax deferred asset pot is owned by the client and subject to an RMD at some point in the future. So we want to put those assets in the tax deferred pot. Roth assets, these are their current combined Roth IRA amounts or Roth accounts. You'll see we split out tax deferred assets by each client. That's because they're two different RMD amounts based on their age. Taxable assets are combined as our Roth assets. Next, we're going to move down to client one assumptions. We're going to assume a life expectancy of 100 years old. You can see their current age right now is 62 at the end of this current year, which is 2025, which is our start year. We're going to assume both of them live to age 100, both Bob and Jane. Next, we're going to come to income sources. Want to make sure we input any, because what we're doing is we're looking at the long-term effects, the long-term tax bill. So we want to make sure that we are covering all the different pieces of their picture that could to add to their tax picture. So what we want to do is include any income sources. So in this case, we have wage income. We're going to assume that Bob, as a painter, he's got some pretty good income, we'll say. You can toggle back and forth between year and age. As you're entering things, I like to think of things in terms of age is a little bit easier for me to kind of grasp. Bob is 62 in the current year. So we're going to, at age 62, we're going to have him earning $150,000 of income. And we're just going to say we inflated it at 2%. I'm going to hit apply and save. One of the most common challenges we see with advisors that put in information here, this green graph is going to give you kind of a sniff test of what that income is doing. Bob's age 62. We have him earning $150,000 of wage income, inflated at 2%. Notice that we have Bob working till age 99. That's not what Bob wants. It's not what your client wants, I'm pretty sure. So just like when you had your old financial planning calculator, I had the 10B2, I think it was, HP 10B2. As you're entering cash flows, you want to put in any row that's going to be a zero cash flow to end that cash stream or cash flow stream. So I'm going to put at age 64, I want this wage income to be zero and inflate that at 2%. So now when we save this, we'll see we have Bob's wages ending at age 64, there's zero. So if you look down here, at age 62, we have $150,000 of wage income. 63, we have 153,000. That's inflated at 2%. 64, we dropped that wage income down to 0, which is what we wanted. So just a word of caution here. If you want a cash flow stream to end, make sure you enter a row with a 0 amount to stop that cash flow from occurring indefinitely into the future. We're also going to add Social Security income for Bob. We're going to assume that he begins collecting his Social Security at age 70. Remember, he's age 70, or excuse me, age 62 now. So at age 70, we're going to have him collect, say, $30,000 for Social Security income in an annual amount. And we're going to inflate that at 2%. We don't want that to end. We're going to assume that continues on for the entire lifetime of Bob. As long as he's with us, he's going to collect that Social Security income. So we're not going to put a 0 amount here. Notice that that amount continues. Also notice that, remember, Bob's age 62. We put in $30,000 here as an annual amount. All these income amounts and expenses are entered in present day or present value dollars, today's dollars. So $30,000 a year at age 70, inflated at 2%. That $30,000 that we enter is actually going to be $35,150 for Bob. So this is that Social Security income for Bob. Let's just say those are his only two sources of income that he has. We're going to jump down to client 2. This is Jane. Remember, she's living to age 100. We're going to assume she's already retired, so she doesn't have any wage income. She's also going to begin receiving Social Security benefits at age 70, just like Bob was. She's going to receive $25,000 and inflate that at 2%. And we're going to continue that on for her entirety of her lifetime. Again, $25,000 at age 70. She's currently age 60. You can see that over here in the background. So at age 70, instead of $25,000, is actually $30,475. So again, we're inflating that present day or present value amount that we enter that in there, and that will be inflated here in the tool. Notice that that Jane has a bump in her Social Security income at her age 98. Remember, she's 2 years older than Bob. Bob passes away. We're assuming that she takes the higher amount, which is going to be Bob's Social Security amount. So that's why you see her Social Security income jump in her final 2 years of life. All right, in addition to Social Security income, we have a pension for Jane. We're going to add a row here. Let's say she's already receiving this. She's 60 years old. And let's say in the current year for 2025, she's going to receive $24,000 a year, $2,000 a month. And we're going to have that, see that we can inflate that at 1%. And there's going to be a 50% survivorship benefit on that. So for pension income, it's like the other sources of income, except if there is a survivorship benefit, we want to make sure we include that survivorship benefit as it is in their pension benefits. In this case, she's 2 years older than Bob, and Bob passes away before she does. But if she were to pass away before Bob in the life expectancy, we would see pension benefit show up for Bob's income. All right, and that's continuing on for her end of life. So we've entered in the income amount here. Expenses, spending assumption right here. This is going to be a pure lifestyle spend number. Holistiplan is going to take on top of this spending, and we're going to calculate the taxes due throughout each year of the analysis. And we're going to tack that onto the top of it, as well as the Medicare premium costs on top of that. So this is purely a lifestyle spend number. We're going to say this starts at the current age, and it's going to be $72,000 a year. Again, these are all present value, present day dollars. We're going to inflate that at 2% as well. We're going to hit apply and save. What we're now factoring in is that there's a $72,000 spending need for Bob and Jane beginning in their current year, 2025. And it's continuing on at 2%. So if you have clients that have spending that changes, there's bumps, there's valleys, you can enter in certain rows here. So if we say age 70, it jumps to $100,000 spending. and they're going to travel for 2 years, and then in 72 we drop it down to $72,000 again. We can add in those different those bumps of spending as well. So when you enter in that spending, you can see the graph here is a good sniff test to make sure it's doing what you want it to do. If we want to delete a row, let's just say they're not going to travel. I'm going to delete these just so we have keep it simple for the illustration purposes. But you can illustrate those changing in spending throughout the years. All right, next we have the option to reinvest or spend all of the excess cash flow. When we talk about what is excess cash flow in terms of what we're looking at in this analysis, uh, if we have income, and by income we mean wages, pension, social security, annuities, all those or these income sources here that we entered, if those are more than spending, if we have an excess or surplus, if we reinvest it all, that means we're going to be taking all that money that's extra and putting it back into the taxable assets to be reinvested at the stated rate of return that we enter here in a moment. If we spend it all, that means that anytime there's a surplus of spending, or excuse me, a surplus of income over that spending, we're going to just lose it all to spending. Consider it additional amount spent, and it exits the analysis completely. So it's not accounted for ever again. You don't get credit for any of that surplus. You can decide which one is most appropriate for you and your client's situation. Those two options allow you to handle that excess however you'd like to. Next section we get to are the Medicare assumptions. Medicare Part B, if you want Holistiplan to calculate the IRMA surcharges and include the Medicare premium costs in the analysis, you'll check that box for Part B. We also do that for Part D if that's also something you want to illustrate. For Part B, we want to indicate the age that they're going to begin Part B, begin participating in Medicare Part B. Remember, it's 65 for most people, but it's not 65 for everybody. If they are still working and still covered by an employee health care plan, they can delay enrollment in Part B until a later date. So indicate the age that they're going to begin receiving Medicare Part B benefits. For Medicare Part D, unlike Medicare Part B, there is no one single base premium for everybody, because remember, Part B is based on the plan that they choose and where they live, their location. So we're going to have to ask for an annual premium amount, an annual base premium amount for Part D. I think the average I read recently was around $50 a month for Medicare Part D. So we're just going to assume that $50 a month, $600 a year for Medicare Part D, and we're going to make those same assumptions for Jane in the analysis as well. Again, Part B at age 65, and again $600 for her annual Part D premium. Next, we have Roth conversions. I'm going to skip that. Wait, this is a good appetizer for putting those in there a little bit later. QCDs, let's enter some in here. So if you have qualified charitable distributions that are planned to be part of the giving strategy for your clients later on in life, we can enter that here. Remember, they're age 62 currently. So we're going to add a row and say that just to show you how fancy the Roth projection tool can be here, just a moment. If I want to start QCDs at age 69, I want to do $5,000 a year and inflate it at 2%. We won't let you do that. All right, we're trying to help you not make mistakes here in the Roth projection tool. So you can only enter QCDs if the client that you're entering them for is 71 by the time the end of the year happens. So change this to 71. Warning goes away. We're going to apply and save. And so now what we're going to have is a QCD that continues from age 71 at $5,000 a year, inflated at 2%. Again, remember, present value. So that $5,000 today is worth $62.17 at age 71. So we've entered QCDs now. Here's the advisor notes section. These are internal notes that you can leave yourself about assumptions you've made. They don't show up on the report when you are in the presentation mode. So up here at the top right, there's a presentation mode. You can click that and the control panel disappears if you want to show this visually with your clients on screen. You can also print this, print to PDF. and print this report as well. So I'm going to take it off of presentation mode and go back, but just know those advisor notes do not show up in that presentation mode or the print mode when you print out of this screen. All right, we're going to go back up now. We're going to move to a couple of other items. You'll see these graph display toggles. You can toggle on or off any of the graphs here in the available here in the menu. I'm going to hit apply and save just to make sure we show the RMD graph. But you can toggle those graphs on or off, off or on rather, whenever you want to show certain particular items of the Roth projection analysis. You can also go back and forth between entering in items by their age at the end of the year or the actual calendar year. You can also show tax and IRMA differences in nominal terms or in today's dollars with a discount rate. What is the most appropriate discount rate? That's really up for you to decide. We don't have an opinion one way or the other. What we do have, though, is if you click on that information icon, you'll see two different articles from folks we trust, Kitsis, Michael Kitsis, and also the FPA Journal, their publication, that speak to what the most appropriate discount rate is to use for these Roth projection analysis. I'm going to put it at 6%. Spoiler alert, the literature out there says pick a discount rate that is similar to the actual return on the portfolio. All right, so we have those toggles and options. Next, we're going to get down to general assumptions. These are some of the assumptions that are some of the most confusing, or some of our users seem to be a little bit confused on what they do, so I want to spend some extra time here. Adjust tax deferred assets. If we check this box, you'll see this button or this entry become white and not gray anymore. What we're doing here when we click on this adjust tax deferred assets, we're trying to show the embedded tax liability of those tax deferred accounts. In reality, your client's tax deferred accounts are not 100% theirs. Like it or not, Uncle Sam is the joint owner of those IRAs. There's embedded tax liability. So what we're saying here with this 24% assumption is that when we start looking at portfolio values, if we check this box, we'll say, don't give me credit for 100% of that tax deferred balance. Give me credit for 100% minus, in this case, 24%. So if we have between Bob and Jane, they have $1 million in tax deferred assets. They really don't have $1 million to spend, though, because there's an embedded tax liability inherent with those tax deferred accounts. So by entering this 24% rate here, we're saying take that $1 million. They really don't have $1 million. They really only have $760,000 that's available for spending. We have pretty vocal sets of advisors on both sides of the argument here. Again, we're agnostic. We don't care which one you choose. It's up to you. But what this box does is say, instead of giving me credit for 100% of that tax deferred balance, back it down based on the assumed tax liability that we're going to assume is an embedded tax liability. You see it's 24% here. That's an arbitrary number. We use 24% because that happens to be one of the middle tax brackets, kind of right in the middle. Ideally, what you're looking for here in this box, though, in this assumption, is we're looking at what would to get really nerdy here, what is the weighted average effective tax cost of those tax deferred assets over the course of time? That's a really hard number to peg, right? So the best proxy we see advisors use is what is their marginal tax rate? And what is their marginal tax rate if they didn't do any of these conversions? And if I look over here at the tax bracket visualizer, we can see that they're in the this yellow is the start of the 24% bracket. So let's just assume that 24% is an accurate number for them, because what we're essentially saying with that 24% number is build in a 24% assumed tax liability if we don't do these conversions for Bob and Jane. Next, the return assumptions. These are arbitrary entries as well. I'm going to assume a 6% return for Bob and Jane, and I'm going to assume that 50% of that return is attributable to growth. So this is another field that leads to some kind of thinking on what is the most appropriate entry here. What this percent of returns attributable to growth, what this means, is that when we have a 6% return assumption, we're assuming that 5% of that, or excuse me, 50% or half of that return is growth. And what that means is that amount is left in the taxable asset portfolio to grow and compound for future distributions. This 3% income, that's how much income is spinning off of this taxable asset, is going to show up on the tax return. So essentially what we're saying here is that half of this 6% return, or 3% of the $250,000 taxable asset account value, at least in year one, 3% times 250,000, that amount is showing up as interest on the tax return or as dividends. It's being taxed. It's not escaping the tax return. On the other hand, the growth portion is staying in the taxable asset account. So it's growing, compounding, and will eventually be distributed at a long-term capital gains rate sometime in the future. The most common proxy we see that works best for approximating this number, think of this as a way to what is the equity allocation of the taxable assets in this analysis. If your client has an 80-20 portfolio, meaning 80% equity, 20% fixed income, then 80% is probably a good approximation here. The higher this percentage, the more tax efficient the non-qualified or taxable portfolio is. And generally what we see advisors do is try to match this percentage with, again, the equity allocation that you have in that taxable asset pot. All right. Last assumption we really have in here in this general assumptions tab is the inflation assumption. This is an inflation assumption that's applied to the tax brackets as well as the standard deduction. And the enhanced senior deduction is also reflected here as part of the new tax law that passed in July of 25. That inflation assumption covers the tax brackets, the IRMA tiers, and those standard deduction and enhanced senior deduction amounts. Actually, we're not inflating the enhanced senior deduction, right? That stays at the same amount in the tax bill. So scratch that last part. But that is baked into this analysis, that deduction. But we're inflating the tax brackets, the standard deduction, and the IRMA tiers by that inflation assumption entered here. Report headings, we just titled it. That's the title we gave it when we came in here. Happy little Roth conversions. We give it a subtitle. It's going to show up here at the top. If you ever get lost here in this control panel and it looks kind of overwhelming, we do have a take a tour button here. If you click on that at the top right, it's going to give you just kind of an overview of that control panel that we just walked through. It also includes a video walkthrough of each of those items, as well as a link to our Roth projection articles that we've shared in the chat so far, and we'll share later. All right, so the first time you go into the Roth projection tool, this will show up by default. You can say, hey, remind me later, I got it, but you can always go take that tour up here at the top right if you'd like to. All right, so now we have, I think we've entered everything we have except for the Roth conversions. I'm saving those for last. I promise we'll get there. It is called the Roth projection tool after all, right? So as we go over here to the right, we see the graphs. The most common one we see folks interacting with, this tax bracket visualizer tool. You can zoom in, zoom out. You can grab certain areas of it. You can save it as a picture. Again, if you want to print this entire projection, you can do that as well, and print all the graphs. But one neat tool we have here, not just in this graph, but all the other ones. If you click on these labels, it'll get rid of certain items. And then we can see that in this case, Bob and Jane are never going to reach this 37% rate. Maybe that's not true for your clients, but you can toggle these lines on and off to get a kind of a more zoomed in look. And when we do that for Bob and Jane, we can see some pretty obvious valley of income, right? Remember, Bob is going to work for 2 more years. So we see those 2 years of wage income. Then we have a drop off. We have a valley of income. Bob starts Social Security at age 70. Jane starts at her age 70. Remember, she's 2 years younger. So hers is age 72. It's barely discernible, but there's a jump there. And then since they were born in 1960 or older, their RMD age is 75. So here we have the RMDs kick in for Bob. Remember, Jane's 2 years younger. 2 years later, at Bob 77, Jane's age 75, her RMDs kick in. And then we kind of have that tax time bomb that those RMDs represent that kick them into a higher tax bracket in their later years. So this is probably one of the most common sweet spots we see for Roth conversions, and that's the age after those retirement years where you have, or excuse me, after those working years, where you have more control over your income. That wage income stops, but you have several years before those RMDs kick in, and you can see a pretty discernible valley of income. So that's where we're going to start looking to add some of those Roth conversions in here now. Now we can finally take a look at the Roth conversions section here in the control panel. So I'm going to open up the client one conversions for Bob. We're going to start with some conversions here for him. And again, I'm looking at a cheat sheet. We have this cheat sheet available as a link in our articles related to the Roth conversion, excuse me, the Roth projection tool. So I've kind of worked some of this out ahead of time, but I'm going to assume for Bob, because I'm looking at this valley, and I'm seeing if I want to max out this 12% bracket. So these lines represent the start of those brackets. So the start of the 12% bracket is 25,000. Start of the 22% bracket is 102,800. And right now we're showing base case ordinary income of 0. Well, how can that be? The answer is this is taxable ordinary income. So this is the ordinary income after the standard deduction, after the enhanced senior deduction, if it applies. So in this case, the only income we have coming in for them is pension income for Jane. Right, we have pension income because she's starting this, she's currently 60, so we have that income coming in. And we have wage income for Bob, and that drops off. So the really only income that we have coming in here is that pension income of 24,000. They're not taking Social Security yet, and the standard deduction more than wipes out that $24,000 of income. So that's why you're not seeing a tax bill here. We also entered a spending number here for them, but remember, the spending, to make up the spending, we're only making up the shortfall. That shortfall is coming from the portfolio. It's coming from taxable assets first. So to the extent that, remember we talked about the cash surplus options earlier, whenever there's not enough income coming in, such as the case here, the portfolio is used for distributions to meet that spending need and any tax bill. So in this case, they have a $72,000 spending need, inflated at 2%. They only have $24,000 of pension income in these lean years right here. So we're making up for that by making distributions from the taxable assets balance here. But because we're taking this money out of a non-qualified account, it's coming out as long-term capital gains, because again, we've had those invested, they're coming out long-term capital gains. Long-term capital gains rate is 0% for taxable income up to 96,700 in 2025. So they're not hitting a point where any of their they have any taxable ordinary income. So they're in the 10% bracket for ordinary income, even with $0 of ordinary income. So